Knowing and using trend lines. It is one of the most basic concepts of technical analysis and charting. So how do we spot proper trends that will help us make profitable trades? Firstly, trend lines are reasonably subjective. You can draw a line from pretty much any point and try to connect it to any other point and then call it a trend line. But that's not really a proper one. So you can always say, oh, I'm going to point this point here to this point here, and you think that's a trend line, but that's not it. There are 3 guidelines to follow. Number 1 is that it must touch at least 3 points. Number 2 is that you should use wick to wick or candle to candle, and try not to mix both as the trend line may be skewed. And number 3 is that the bigger the time frame the trend line is on, the more valid it is. When a trend line is drawn at the bottom and moves upwards, so something that looks like this, then that is an uptrend. We use the points that the trend line touches as a major support zones. For example, we're looking at Apple on the daily time frame, and you see that this trend line here that I've drawn is valid because this is a zone, this is a zone, and these are all major support zones that support this line all the way up and keeps the uptrend intact. So even if you say you bought at 121 at the high, eventually it would pop back and you would be in the profits. Or if you bought at 125, you would still eventually pop back up and be in the profits the entire way. When a trend line is drawn from top and moves downwards, for example like this, then this is a downtrend. We use the points on this trend line touches as major resistance zones. And our example we have here is Tilray. And looking at this, you see this trend line that I've drawn here, you have major resistance zones. You have multiple touches of this trend line, thus making it a valid downtrend line. So if you try to play this short at any time, even though it'll come back up, if you short, eventually the prices would still move downwards on the longer time frame. So a really good and simple play is to buy at the support zone and sell at the resistance zones on an uptrend. And if you're playing a downtrend, then what you want to do is short on the resistance zones and cover on the support zones. For example, we look at Apple. We can always keep buying. If you consider that this trend line was going to form and it hit 126, this trend line becomes valid. So buying at this zone here, this long consolidation zone, would net you a decent gain from 126 to 144. It also makes it very easy for setting a stop zone as well, because if it breaks down from, let's say, 123 or 119, then this uptrend may be in jeopardy of breaking down to become a downtrend if not trade sideways. With Apple and Tilray, both charts trend line meet the number 1 rule, which is that it must touch at least 3 points. And the more points that it touches, the more confident it is, even if it's just wicks. So you see here, this is a candle with the candle touching. This is a wick touching. This is a wick touching. This is more or less a candle touching. Candle, candle touching. A few more wicks touching, but you see the amount of touches that it gives makes this trend line very, very clear and confident. And sometimes the wicks will extend below the trend line, but it closes back up over within the trend. So for example, if you look at Apple, you see this one here, it dipped below, the wick dipped below, but it closed within the trend line, so there's no follow through and bulls immediately bought the dip. Therefore, it still counts as a touch, even though it dipped just below the trend line. This leads us to our second point, which is to go either wick to wick or candle to candle. And I personally try to go candle to candle as much as I can, because there can be a lot of phantom wicks or extreme price action due to news or whatever reason that draw the trend line off course. while candle to candle gives me a much better average on how the stock is doing. And as mentioned before, the wick may cross the trend line, but as long as it closes within it, it could still count as a valid touch. And wick to wick trend lines gives you an actual price action, and it can actually work better. And it includes all the extremes so that you may be less likely to be faked out if the prices drag too far to one side or another. While if you just use candles, it may break the trend line temporarily but close within the boundaries. And the third guideline we have to look at is the time frames. A trend line that's on the weekly or monthly is much stronger than a trend that's on, say, the 5-minute or 15-minute. And it could be, for example, a daily uptrend, but a 15-minute downtrend. And this can be confusing, so it really depends on the time frame that you want to be trading in. You may be thinking that it's a 15-minute downtrend is a great opportunity to dip buy because you're looking at the daily uptrend. While if you're scalping, you may be shorting for a few cents on the 5-minute time frame. So we always have to use the trend as your friend. The reason why bigger time frames are much stronger is because it takes into account many more trades and price action and participants. The scale is grander, so it's more likely to head in that direction over time. For example, we're looking at Square here as a chart, and this is the weekly time frame. And from the COVID lows in March 2020, we looked at this line here. This trend line on the weekly has continued to move up until March the 1st of 2021. That's where it broke down, but it still kind of hovered at the bottom trend line before breaking and holding this key support zone range and pushing back up into the trend line. So it's not a clear downtrend yet, but it could be trading sideways. So just because it's not an uptrend doesn't mean it necessarily is immediately a downtrend. So until we see Square do something like this, unable to break a higher high and pushing back down low, then we'll consider it a downtrend at this point, and something like this downwards. Sometimes we have clear trend lines that are going in the same direction, and when that happens, the trend lines become what we call channels. For example, look at DraftKings here. This is a clear channel. Whether it's a uptrend or downtrend channel, this gives you even more information and clearer support and resistance levels, and you can easily make that simple play of buying in support and selling on resistance. So check out DKNG here. We have a channel forming with a resistance trend line and a support trend line. So it makes it very easy to identify where you should buy and where you should sell. Something like this, for example, let's say it touches the bottom here and it pushes up to 64, 65, and that makes it a valid trend line, and it's very easy to make this buy and make this sell. And look immediately, look what happened. It came back down to 53, hit this trend line on the wick, and pushed right back up. And you see this, how it closed within the trend line. Look at this long upper wick. So this makes it very easy to make clear plays and indication of where the support and resistance are. Let's look at another channel here on Futu, and this is a downtrend channel. So this hit all-time high at 205, and you see how this big area here was a constant uptrend until it hit this double top range where it couldn't break any higher and started to come back down. And this downtrend created very clear supports and very clear resistances until this zone here where it broke over. But you see how it came back and back tested and just kind of hung out on this trend line. So that makes it a very clear support zone now, which is previously a resistance zone. A channel is when two trend lines are moving in the same direction, but when two trend lines are converging, this can lead to an equilibrium. This means that the coil is getting tighter and tighter and tighter, and eventually the prices will break out in one direction or another. And there is another play strategy here as well, because your risk is low as you have a pretty tight stop loss, while you can have a big reward play. For example here, looking at AES, you see this trend line moving up as the uptrend line. This is coming down as the downtrend line. And you see how it's coiling tighter and tighter and tighter until it'll eventually break out either this way, uptrend, or downtrend. But it's very easy because you have a very clear stop. Let's say you enter somewhere here, your stop would be 25.17 here, because once it breaks that with volume, then it becomes very clear that it's broken bear. Using trend lines helps you tremendously because it allows you to identify if something is moving up or moving down. And even if you buy high on a uptrend, for example, if I was thinking that I buy here at $50, $49 here, thinking that this would keep going up, even if you, as long as you're able to weather the storm when it comes back down, it eventually moves back up and the trend continues upward. And very similarly is if you short on a downtrend, it could look bad in the short term, but eventually over time it moves itself down. So in the comments below, let me know if you use trend lines on your day-to-day trading or investing. What guidelines do you follow when you are drawing trend lines? And if you enjoy this video, make sure you hit that like button, subscribe to my channel, and we'll see you guys next time for more educational stock videos.